Have you ever wondered why gold and silver often move in directions completely opposite to stocks, bonds, or even currencies? Today, we're diving deep into a critical distinction in financial markets that every investor, economist, and curious mind should understand. Why do precious metals react fundamentally differently than paper assets? This isn't just about market trends. It's about the very nature of value, risk, and economic stability, offering crucial insights for portfolio diversification and financial education. Paper assets, at their core, are sophisticated claims. They represent a promise or an expectation of future value, intricately woven into our institutional and legal frameworks. Stocks, for instance, are claims on a company's future earnings and assets. Their value hinges on corporate performance, management efficacy, and market sentiment. Bonds, conversely, are claims on future interest payments and principal repayment, relying on the issuer's creditworthiness and prevailing interest rates. Currencies, the most ubiquitous paper asset, are claims backed by governments and central banks. Their stability depends on fiscal discipline, monetary policy, and public trust in the issuing authority. The value of all these paper assets is inherently tied to the performance and integrity of underlying institutions and the broader economic environment. In stark contrast, precious metals like gold and silver are not claims. They are physical, tangible assets. Their value is intrinsic, derived from their scarcity, historical acceptance, and unique physical properties. They exist independently of any government, corporation, or financial institution. This fundamental difference means they carry no counterparty risk. Their value doesn't depend on someone else fulfilling an obligation. This makes them a distinct category in economic analysis. One of the most profound differences lies in the concept of ownership versus obligation. When you own a stock or a bond, you own a promise. When you hold a currency, you hold a government's pledge. A bond requires repayment from a specific entity. A stock's worth is tied to a company's ongoing success. A currency's purchasing power relies on continued trust in the issuing central bank and its economic policies. These are all obligations. Gold and silver, however, do not rely on future promises or the solvency of a third party. They are direct, unencumbered ownership of a physical commodity. This structural independence profoundly influences their behavior, especially during periods of economic uncertainty or systemic stress, making them a unique tool for portfolio diversification. Paper assets are highly sensitive to monetary policy shifts. Interest rate changes, quantitative easing, and fiscal stimulus directly impact bond yields, stock valuations, and currency strength. Their movements often reflect expectations about economic growth and corporate profitability. Precious metals, particularly gold, tend to respond more to broader monetary conditions over time, acting as a hedge against currency debasement. They reflect changes in the real value of money, often appreciating when real interest rates are low or negative, and when inflation erodes the purchasing power of fiat currencies. This makes them a crucial component of economic analysis during inflationary cycles. Historically, precious metals have served as enduring stores of value, particularly during periods of monetary instability or geopolitical turmoil. While paper assets often experience extreme volatility as confidence erodes, gold and silver have frequently acted as a monetary anchor. From ancient civilizations to modern financial crises, they have maintained purchasing power when fiat currencies have failed. This historical role underscores their importance as a hedge against systemic risk and a barometer of underlying economic health, offering valuable lessons for financial education. Paper asset markets are characterized by immense liquidity, often facilitated by leverage and complex derivatives. Their pricing is influenced by rapid information flow, algorithmic trading, and the interplay of institutional investors. This can lead to swift, sometimes volatile, price movements. Precious metals markets, while also liquid, operate with a different dynamic. Physical metals represent direct ownership, reducing the systemic leverage often seen in other markets. While derivatives exist, the underlying physical asset provides a tangible anchor, influencing short-term behavior and offering a different risk profile for investors. The psychological drivers behind paper asset investments often revolve around growth, future income, and the pursuit of higher returns, often fueled by optimism or greed. Investors seek to capitalize on economic expansion and corporate innovation. Precious metals, conversely, often respond to concerns about wealth preservation, stability, and protection against systemic risks, often driven by caution or fear. They are sought during times of economic uncertainty, geopolitical tension, or when trust in traditional financial systems wanes. This psychological distinction is vital for understanding market behavior. Confusing precious metals with paper assets leads to significant misunderstandings and suboptimal investment strategies. Expecting gold or silver to behave like growth stocks, for example, sets unrealistic expectations and overlooks their primary function. Understanding their distinct roles is paramount for effective portfolio diversification. Precious metals offer a non-correlated asset class that can reduce overall portfolio volatility and provide a hedge against inflation and systemic risk, complementing traditional paper assets. This is a cornerstone of sound financial education. During inflationary periods, the divergence between paper assets and precious metals becomes particularly evident. While some paper assets may struggle with rising costs and eroding profit margins, precious metals often thrive as a hedge against currency debasement. Inflation erodes the purchasing power of fiat currencies, making tangible assets like gold and silver more attractive. They reflect changes in the real value of money, offering a potential store of value when nominal returns on paper assets may not keep pace with rising prices. This is a critical aspect of economic analysis. It's crucial to understand that precious metals are not inherently superior to paper assets. They simply serve different, complementary purposes within a well-constructed financial strategy. Each asset class responds to distinct economic forces and fulfills unique roles in a portfolio. Paper assets are essential for growth, income generation, and participating in economic expansion. Precious metals provide stability, wealth preservation, and a hedge against systemic risks. A balanced perspective, acknowledging these fundamental differences, is key to avoiding oversimplification and making informed decisions. Precious metals react differently than paper assets because they are fundamentally distinct in their structure, function, and dependence. They represent tangible wealth and reflect monetary change, rather than institutional performance or future promises. Understanding this crucial distinction allows investors, economists, and the general public to view gold and silver with clarity, rather than misplaced expectations. This knowledge empowers you to make more informed decisions about your financial future and build a truly diversified portfolio. If this deep dive into financial fundamentals has illuminated your understanding, please like this video and subscribe to our channel for more insightful content. Your engagement inspires us to continue providing valuable financial education and economic analysis. Share your thoughts in the comments below. What other financial distinctions would you like us to explore?